joining us today. So we wanted to touch base with you guys. There's a lot of uncertainty now in the financial system and the markets in general. So we wanted to touch base with you guys just to see, let you know what we're seeing, and as Ahmed said, have some Q&A as well. So first, what happened with Silicon Valley Bank? That's a big question in everybody's mind. So basically, banks tend to match their assets and liabilities, and this is something that Silicon Valley failed at doing so. It was bottom line, it was poor risk management. As you guys know, banks take deposits, they pay you an interest on those deposits, and then they either lend those deposits out at a higher rate or they invest them. So most banks lend those deposits out. SIVB or Silicon Valley Bank was the anomaly, if you may, where most of their assets were actually invested. And what they did is they invested them in securities that were high duration, long dated securities. So what this means is when rates go up, the value of these securities goes down. So back in the pandemic, the bank took about $300 billion worth of deposits from venture capital and startup companies. Let's remember that this bank was the premier bank for startups and venture capitalists. They took a huge amount of deposits, and when rates were low, they went out and they invested them in high duration securities, thinking rates are going to stay low for a while. Well, fast forward to now, rates went up very aggressively. The value of the securities went down, and at the same time, on the other end, a lot of the venture capital companies, they burn through cash quite quickly, more than normal companies. So they went to the bank and said, hey, we need some more deposits. The bank said, we don't quite have them. Securities are a loss. So what we'll do is we'll issue equity, $2.25 billion in equity to cover some of those losses, so we can give you your assets. And a lot of the depositors panicked, and hence you had the run of the bank that we saw. So it's estimated that as of Friday, SIVB had a shortfall of over $1 billion in cash. The bank, as we know, collapsed. So the FDIC stepped in, took it over, auctioning off the assets. And what they're doing too is they're trying to preserve the faith in the U.S. financial system. We saw Janet Yellen come out, saying we're going to back up the loans of not the loans, I'm sorry, the deposits that are in the bank. And it's important to keep in mind that before this happened, if you had an account in the bank, FDIC insured you up to $250,000. 87% of the deposits that SIVB had were accounts over that amount. So most of the deposits were uninsured. So that's why the FDIC stepped in. They said we're going to insure all deposits, and by the way, we're doing this for all banks out there, at least for a year. Banks that have issues, we're going to do a very easy lending to you on very easy terms. So they're trying to backstop the financial system. So that's the positive. And in a nutshell, that's what happened with Silicon Valley Bank. Implications for the financial system, is who's next. We saw already Signature Bank in New York go down over the weekend. There will likely be other small banks that are going to probably go under. Banks that are very concentrated in certain assets, or banks that have a lot of investments versus loans. There's risk out there. However, we don't think that at this point, this is going to become a contagion for the entire financial system. Most banks out there, particularly the big financial institutions that were once deemed too big to fail, have very diversified asset bases, very diversified portfolios. They have a lot of more stringent rules they're abiding by. So the panorama, the environment is very, very different than it was in 2008. So we don't think there's going to be a contagion to the general financial system. Something we're seeing out there is companies like Charles Schwab, for example, getting, the stocks are getting hit pretty hard. People are thinking, is this going to happen to my deposits? And that's a very valid thought. But if you look at Charles Schwab, they came out saying, hey, listen, we have about 100 billion that we can access in liquid funds. If we had an issue like this, we're covered. And most institutions, you name it, Charles Schwab, Bank of New York, JP Morgan, they're very well capitalized, where the chances of this happening to them is very, very small. So we don't think this is going to turn into a overall financial contagion. But at the same time, we're keeping our eyes on everything, and we'll keep you abreast as the situation develops.
Yeah. Let me throw in a couple of points in there, Mauricio, as well. And sort of to highlight some of the peculiarities, let's say, and idiosyncrasies of SVB Bank that we saw. So we took a look at their balance sheet. And if you look at the number of securities that SVB Bank held as assets, it was 57% of their assets, 57%. The rest of the banking sector in the United States is under 30%. So if you take a look at the big money centers, securities as a percentage of assets, they're under 30%, anywhere from 20 to 25%. And if you look at the regional banks, they're also under 30%. So this was a very particular situation with SIVB Bank, where they had a massive portion of their assets, much double than what the industry and segment average is, in securities. And as you can imagine, these securities were almost uniformly and universally long-dated treasuries and mortgage-backed securities that have obviously taken a massive mark-to-market hit and mark-to-market loss. So that's where the mismatch came in. At the same time, on the other hand, you also have the fact that most of their clients, like Mauricio mentioned to you, are tech companies and tech startups. Remember, these are usually companies that burn through a lot of cash, okay, because they're not making a lot of revenue because they're growth companies or tech companies that are supposed to be getting revenue in the future. And their deposits started shrinking because they didn't have money to deposit in there. So really, this was a situation where the bank was squeezed from both sides. Number one, because the number of securities as a percentage of assets held in their accounts was more than double what you see out there in the United States, both on the SIFIs, the systematically important financial institutions, and the regional banks, and also the peculiarity and idiosyncrasies of their deposit base as well. Go ahead, Maurice.
I think that's a good distinction to make. The assets, the depositors that SIVB had are very, very concentrated and very, very differentiated. So again, we see this as contained to this bank. Again, we're not saying that other banks are not going to fall, because some of the other smaller banks that could have similar peculiarities could be affected. In fact, you're seeing banks as Zions in New York, First Republic. You're seeing their stocks getting crushed. And frankly, this is an important distinction to make. What investors are saying is, well, the depositors are getting bailed out, but the investors and the creditors aren't. So as an investor, why should I hold this stock when I'm going to get bailed out? And that's what Janet Yellen said on Saturday. She made it clear that this bailout was not a bailout for investors or creditors. It was a bailout for depositors. So it's a very, very different environment than was in 2008. And Ahmed, if you want to touch on some of the implications for the Fed.
Yeah, absolutely. So actually, before I do that, let me make one final point, because a lot of questions that we've gotten today from clients is, hey, should we buy into this dip into the bank stocks, especially the regional banks, which are down very strongly compared to even the SIFIs? We don't think so. We do think that banks, their cost of funding is going to go higher, and their net interest margins are going to get squeezed. So I don't think the earnings outlook for the banking sector, given the developments over the weekend, are very positive or favorable. So we think it's still too early to consider going into the banking sector, especially the regional banking sector. I think those are potentially where you have the greatest vulnerabilities. And surely there will be others, right? There'll be another bank or two that goes under. That we can probably say with a high degree of confidence and conviction. Let me also tell you another reason why I don't think it's a good idea to jump in right now. the way that the Fed and the Treasury have bailed out the banks here in this situation, or bailed out SVB Bank to be specific, and Biden was very clear today when he said that this is not being funded by the taxpayers. Well, guess who it's being funded by? It's being funded by the banks themselves. So this is being funded by the premiums that the banks are paying into the FDIC to cover these losses on term deposits. What that means is that the cost of funding, the cost of capital for banks across the board is going to go higher. Now, you could argue, well, the systematically important financial institutions like JP Morgan, Citi, they already had high cost of capital. And that's true, they did relative to the regional banks. Well, this just means that the regional banks are going to most likely have increased pressure in their cost of capital going forward. And at the same time, they're going to have to start paying more for these term deposits because people are like all of a sudden saying, whoa, maybe these banks aren't as fortified as we thought. So that cost is going to go up for them as well. So they're going to have to pay higher premiums into the FDIC. They're going to have to pay higher rates on their term deposits, and they're most likely going to have to pull back on some lending activity. So we see earnings and margins being squeezed on both ends for the banking sector. So no, we do not think this is an opportune time to buy into the banking sector. Just wanted to highlight that. Any follow-on comments?
Yeah, if I could add to that, so to your point, a lot of the banks are going to get squeezed on both ends. We had mentioned before that in a market that's going down, like the one we're seeing, you want to be in certain sectors, just like consumer discretionary, some of the cyclical value sectors, which is energy, financials, and industrials. Within the financial sectors, what we had said is stay in the large diversified asset players, the JPMs, the Morgan Stanleys, even the big bank ETFs like XLF. So to Ahmed's point, we still think it's too early to get into even those kind of banks because there's going to be a lot of noise in the system. We have more confidence in the bigger diversified banks with a big asset base with different revenue streams, like wealth management, capital markets, things like that, not just purely net income margin, not just purely regional banks. So that's something to keep in mind.
Yep. I think that's a great point. So just to recap on these 2 points. So the number one point is that we do not see systemic risk to the U.S. financial system based upon this particular situation and the Fed's or the way that the Fed and the Treasury handled it, which I'm going to get into in a minute, because I do think it has monetary policy implications. So I will discuss that now in a minute. So first thing is we do not see systemic financial risk emanating from this, but at the same time, that doesn't mean it's time to jump into the bank names, especially the regional bank names. We still think it's too early. We still need to wait and see what developments happen here over the next couple of days. Remember, in environments like this, discretion is the better part of valor. So let me make a few points on what I think the implications are for monetary policy, because I think in a certain sense, the market today has misread potentially what could happen out of the Fed. And let me explain to you what I mean by that. So what in this bailout of SVB Bank, what the Fed did, the Fed basically created a new facility where they are allowing banks to pledge their assets, these long-term, long-duration assets that I'm talking about, treasuries and mortgage-backed securities. They're allowing these banks to pledge these assets as collateral at par, not at mark-to-market. So at par, and this is a key point, because they're going to pledge these assets at par with a spread of a one-year lending facility at OIS plus 10 basis points. Why is this important? Because the Fed is sort of setting up the point where if any banks get in trouble, they're going to be able to access this facility. And they're going to be able to do it with at par, not at mark to market. In my mind, what that means is that I don't think the Fed is necessarily going to be cutting rates as fast as the market's potentially thinking right now. Now, if the situation worsens and we see contagion, then that's a different story. But the way we see things right now, I think the market has been too quick to price in rate cuts from the Federal Reserve. Just to give you an example, as of Friday, the market was pricing in roughly an 85% chance, 90% chance that the Fed was going to raise rates by 50 basis points at the meeting next week on March 22nd. Right before this call started, I checked the Fed funds futures, and it was roughly 50-50 whether the Fed was not going to raise rates or whether it was only going to raise rates by 25 basis points. Now, I think that's a good place for the market to be, meaning it's a toss-up whether the Fed is going to not raise rates at the next meeting or raise rates by 25 basis points. Let me explain to you why. The Fed right now is facing two conflicting forces. One is arguing for no more rate hikes, and that is the force of financial stability. So the Fed is facing a situation right now where the financial stability of U.S. banking institutions is coming into question. So that argues for no Fed hikes at the next meeting. However, there's another concern, the medium-term inflation outlook. The medium-term inflation outlook, in the Fed's eyes at least, is arguing for further rate increases. So those two forces are in direct conflict right now. Now, I do think that if push comes to shove, the Fed will choose the short-term financial stability consideration over the medium-term inflation outlook. But remember, we have a CPI print coming out tomorrow morning in the United States. If that number comes in much higher than expectations, it's going to put the Fed in a really, really difficult spot, because the Fed's going to have an even tougher balancing act between the short-term consideration of financial stability and the medium-term considerations of the inflation outlook. So keep your eye out on the CPI print tomorrow. That's going to tell us to a great degree which way this market is going to go here, and whether the market is going to have to unwind the monetary policy easing that it baked in today after the developments of today. So to recap, we do not see systemic financial risk. We do think it's too early to jump, especially into the regional banking names. And we think that the monetary policy implications are potentially not as dovish as the market is pricing in today, or as the market has repriced in today.
Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://advisorinfo.sec.gov/.